welcome back to this part 2 of the ACCA's AAA Examiner Debrief. Now, we're going to cover question 2 and 3. So we're going to be looking at the questions that are not focused on planning, they're not briefing notes, there's no communication marks, okay? But again, continuing where really the marks start to go downhill, because these questions, we normally see some nicer bits in it, but we also see some much more practical stuff, and we see a question on completion reporting, which sometimes goes one of two ways. It depends on really what you're getting. Okay, we like an uncorrected misstatements question, like those kind of ones, because they tackle the financial reporting side. But when we've got something like this, this really can cause some problems if we're not explaining ourselves properly or not understanding what this means. So question 2, when we're looking at it, is focusing on a due diligence engagement. Now, that is not an audit. Okay, it is probably a separate team. It could be the same team that does it, depending on how big or small the firm is. But in this case, we've got a very large transaction advisory team. Okay, sorry, a very large firm and a transaction advisory team. So we know that they're probably experienced in what they do. They are also an audit client, which is important. Okay, so over here it's picking up the fact that they're already an audit client. Okay, and also I said they're an unlisted firm, which may or may not be relevant for ethics purposes. So as expected, when I saw this, I was like, okay, this might be okay, it might not be, but the performance on it wasn't great. Okay, they called it disappointing and weak, okay, which is not not really words we use to that's a flattering way, do we? So the first bit was, I said, ethics and professional matters, which there's a question 1, 2, and 3 that also had this, which probably tells me students didn't get all 3 of these questions in their exam, because this was fairly similar on each one. If not, I'd be thinking this is great if I was good at this question. So they are completely different things, ethics and professional. Ethics is very much about your typical ethics, self-interest, self-review, all that good stuff. Professional things is more about what the auditor would care about. So that's more about the kind of more practical matters from the workplace. So do we have a big enough team for it? Are they in a location we can get to? Do we have enough time? Like those more practical matters, that's what we're really looking at. So prior to tendering tells me you should have thought about this before you then took on the client. Like it's quite a big thing before you take on the client and go, oh, whoops, oh, we don't have anyone that specializes in that area. Okay, it's going to be a bit of a problem, right? So those are the kind of things that, again, students trip up on, where is this important enough to think about before we accept it? So what the examiner said was students didn't read the scenario, which is probably pretty important when you're looking at an exam, because there were 2 particular things that were mentioned in the question that if you were writing down some generic ideas like revision notes, you'd be thinking, right, what do I need to consider? Do we have enough competence? Do we have enough staff? Is it going to be a separate team to the audit team? The examiner in this case had ticked both of those boxes for you because they put in the scenario about this. That means it's done, it's ticked off, and you can't talk about it. Okay, so again, it's talking about ethics and professional issues. That means they're already dealt with. Things I actually care about as a problem. So done, professional matters. It also mentioned extremely short timescale, which is good. Okay, well, the short timescale isn't good, but the fact that people picked it up was good. But also the fact that they were in a different location. Although if you evaluated it and you went back up to the question, it mentioned your firm has offices in 100 countries. Okay, that would be your evaluating it. That would be you saying we may have an office in that location given we have 100, but this might actually mean we don't have enough staff or the right staff in that location. So again, if that's the evaluation level. Okay, then the more broad bits that are in basically any kind of assignment like this, any non-audit itself, is who's going to be the person we're giving this report to, who's going to be relying on this report, hence the users pops up. But what we don't care about is it's an agreed upon procedure. It means we're telling them this is the amount. Okay, it doesn't mean there is a level of assurance. And again, that is always comes up, that there's a lot of people that don't understand that when you have an agreed upon procedure, there is no assurance. Okay, there's no opinion, no assurance on the end of it. Okay, that's only the case in the audit or limited assurance engagements. Okay, again, where we say like nothing came to my attention. So carrying on, as I said, more difficult bit we start to see where things are given to you or they're not the standard little bits that you've seen before. So ethical issues, classic, will be in every exam, but familiarity threat, really common. Okay, if you're working close to them. Self-review threat, again, management responsibilities. Management responsibilities is particularly more difficult that students find, but it is basically taking on the job of a client or something that looks like you're working very closely or like you are the client. Okay, and that's the problem. So in particular, some people mentioned about the auditor reviewing their own work, when actually it was the due diligence we were looking at as an issue. Okay. And then self-review threat is really common, but again, just think about being careful because they were looking at the due diligence on an acquisition. So in this case, if the acquisition is successful, that would mean it would be maybe part of the group structure, and then you would be auditing that. And so it's that specificity of not just, oh, you review your own work as part of the audit, and that's kind of it. You need to go into the specific detail they give you in the question and talk about how that might then appear, and then why that's a problem. Usually it's about not challenging your own work. And then the final bit was mentioned was about the audit manager, okay, being someone who supports. Well, that kind of really compounds the whole point about them being too familiar or the self-review threat as well. What other people dropped in was self-interest and advocacy, and there's nothing in the scenario. So again, doing more work for an existing audit client is a self-interest threat, but it's about what's the important ones in the scenario. So there was specifically no mention of fee. We didn't know how much it'd be. So some people just went with their automatic self-interest threat when actually the question had enough stuff to get more than full marks without mentioning self-interest. So the examiner's like, it's not important. And then it would probably have affected their professional skill marks as well. And the same with advocacy, there was nothing in the question, whereas there was later. As we move to the warranty obligations bit, again, this is justify why it would be a focus. So any answers that talk about why it wouldn't be, not getting any of those 4 marks, and probably drop the parts of professional skill. And then recommending due diligence. So again, not very well done, okay, but particularly justifying why. Okay, now warranty obligation, without even looking at any of the detail on what the warranty was, it is subjective. We're estimating, for example, how many people will claim on the warranty on their washing machine. I don't know. The client doesn't know exactly. It's a future-facing thing. So we're trying to challenge that estimate. And then the due diligence, whenever you see that due diligence or tests in this case do better than the other parts, the other parts must have been pretty bad. Okay. So when we move to it, as I said, it's a significant liability. The key point about how they got to that number and how they managed to value it. So how do they know how much the repairs or the replacement will cost? And that's what we just don't know. It's a future thing. Even more particular was because it was for 7 years. Okay. So the fact that it mentioned it was a 7-year warranty was even more so why it was a problem. What wasn't the case was when people start talking about the fact that it was a revenue recognition issue, which was not relevant for this question. Okay. And what was also relevant was the manipulation that was there. There might have been something to indicate that the client were going to manipulate it for the price purposes, again, which might have understated the value. When we get to tests, okay, so our tests over here are due diligence procedures. Now, if you treat your due diligence procedures like your audit test from the case study, then you'll be on the right path, okay? So same structure, but remember, this is not an audit, therefore audit stuff is not necessarily relevant. So disclosures are a financial reporting issue. This is a due diligence piece of work. We don't care about the disclosure. In the same way, we don't care about the written representation because it's asking us to, let's say, identify specifically how much that should be. Now, in the audit, I care about how much that should be and the disclosure. In the due diligence, they're telling me, is this number correct? Okay, so it's very, very refined to exactly what the client has asked you. Okay, whereas that audit is about reasonable assurance. Okay, so challenging the accounting treatment was really important. Okay, challenging the number was important. Challenging the accounting treatment was not important because we didn't care whether it should be a warranty obligation or it should be some kind of revenue thing. We didn't care. It wasn't the purpose of the engagement. So hence, again, there was no credit for it. Okay, we're looking for challenging the number itself, not whether it should be an obligation. So what we're looking at, things like the terms of the warranty, what was covered, which models, okay, so which specific models were covered, any changes. So have there been more breakdowns in a type of model? We were looking at how many claims have been made in the past few years. That's a really good indicator for potential claims in the future. Okay, have they had to have any rebate reclaims for things where they know there's a known fault? Okay, that's a pretty good bit of evidence. Okay, so due diligence done. As we moved to question 3, it was about key audit matters, and I was like, oh, this is going to be an interesting one. Okay, there's some students who are going to do really well on this. Okay, and there's some students, if you don't know what a key audit matter is, that could really derail most of the question. Okay, so key audit matters that are really important to the audit. So what's going to be really important to the audit? Okay, well, everything's important, but in terms of what needs to be in a listed company's key audit matters, meaning in the audit report, there's a section on key audit matters because it's about giving more transparency and more detail on it. That is going to be really, really, really important things. Okay, so obviously going to be material. Okay, obviously going to be something that's really subjective. Okay, or something that's really important to whoever is going to be reading it. So first up, we're looking at purpose of it. So one of the purposes is it's for listed companies, so it's complying. Okay, so that's one of the key things, and it's to give users more information, okay, to make their decisions, not to decide whether it's like, oh, is this company going to be worth more? No, it's to give them information about something that's really subjective that we had to, as an auditor, challenge quite a bit. As we move to the content, though, the content is thinking I can visualize what a key audit matters section looks like because I've seen so many reports. You need to have a look at a key audit matters section of an audit report so you can visualize it, particularly if you're someone who likes to remember things in that way. So I can remember, right, you've got your key audit matter, you've got the materiality of it, you've got why it is a key audit matter, you've got an outline of the detail around it, the value of it. And then on the other side, or somewhere in there, you'll have how it was tested. So that's going to be really important. Okay, so it sampled this, they physically inspected that, they obtained an expert's opinion on something. All that stuff's going to be in there. So some people ignored the examining team's instruction, which is probably not ideal, and mentioned exhibits. Now, to be fair, I've got some sympathy there because I would ram to my students and be like, make sure you're referencing the scenario, make sure you're clear about it. Now, I don't tell them, say, per exhibit 1, because that would be unprofessional. But in particular, I'd be like, use the scenario. In this case, they were like, don't use it. And I was like, oh, well, get over it. So said it's mandatory for listed firms. Okay, it's about significant things that have been addressed and how they've been addressed, which is the content of it there. It's about being more transparent. It's about challenging potential judgments. Okay, so common things that would be in there will be things like going concern. So if there's material uncertainty, that would probably pop up in there. Okay. So anything that's really, really significant to the business that is also maybe highly subjective. Okay, so maybe, as you'll see in a minute, their treatment of revenue recognition might be subjective. Okay, or maybe they have a significant, a high amount of crypto or something or a significant number of investments that fluctuate in value a lot. Okay, well, then we're going to have a bit more challenge over it. So then we got on to justify whether the matter should be included in the key audit matter section. Okay, so you need to give a clear answer. It is or it isn't, right? That needs to be your end answer. If you sit on the fence, you'll lose a professional skill straight away. And then particular features. Always they do this when they have a quality management type question. They go, please don't draft it. They don't care about how you write the audit report. They don't expect you can write an audit report. They don't care about how the disclosures are written. They care about the detail that's been given. So tell them what should be in there. But the main thing you're going to get your marks for is that top bit, justifying whether each of those key audit matters should be in there. So some very, very good answers, which is always great. We're always happy with that. Okay, when we see some really good answers, okay, lovely. And then they start going a bit more detail. So going to the first ones, okay, if you want to do this exam question, then to pause it for a bit. But rotating an audit partner, that's an ethics thing. Okay, we would tell the audit committee or those charged with governance if it wasn't the audit committee. So we would tell them, but it's not something that's going to pop up because we deal with that elsewhere. The things we're dealing with in the key audit matters are financial reporting issues or things like still going concern, right? Related parties, those kind of things we're dealing with in key audit matters. We're not dealing with ethics issues. So that was an automatic write-off because that should have been dealt with elsewhere and that would not appear in the audit report. Then financial reporting issues, here's where we could go either way. So revenue recognition should be included, but only for the reasons that were given in the question. So not every company's key audit matters includes revenue. It's just that in this case, they mentioned there was a complex contract. So therefore, we can justify that we may need some kind of expert team internally or externally. The disclosures around that are going to be potentially quite detailed. So we're going to, again, need to scrutinize them a lot. That made it higher risk, very judgmental. And the same with intangible assets. Well, amortization, we're going to have to decide, the client's going to have to decide the useful life, okay, or how long that's going to be amortized for. Is also going to be disclosures, and there's going to be judgments about whether those intangible assets are impaired or not, okay? So all those different things that we're going to see there means judgments, a lot of judgments, okay, and something that's very subjective. So we're going to need to challenge it more, and particular because they had a substantial amount of intangible assets. That again meant that it was a key audit matter. So it wouldn't be for every company. So you see, you really needed to justify why, okay? You needed to have a very clear yes, no answer, or you won't get any credit, okay? If you said yes and no, I'm not giving you any credit for it. And then I said, finally, as we went to professional and ethical matters, we've covered this in both the last kind of couple of questions. In particular, looking again, professional issues is about the more practical side. So this is like the go-to for an advocacy threat. So audit partner, pop along with the meeting, wear the T-shirt of our company's name on it. We're getting a bit too close to them, right? We're kind of appearing like we work for them, okay, or with them, or sit at the same desk in the same office as them, right? So whenever you see something about a meeting, you're like, oh, no, right? The answer is no. Okay, so when you have an advocacy threat, it is a no. So when we look at this, it's also the fact that we have a management threat. Are we basically working for them? Are we making a judgment for them? Okay, and then also I said, to give you the example of the wearing the company's T-shirt, probably not going to happen, right? But that also means we might see that maybe they're a bit too familiar if they're going to meetings together. I said posting on LinkedIn saying, "Oh, what a great company to buy shares in." That's going to be a problem. It's going to create a potential liability. But what should have been the easier thing in the question is contingent fees. Contingent fees is always a no. Okay, contingent fee needs to be a fee set based on the complexity of the work, the risk of it, the timing, all that kind of stuff. Never ever accepting a contingent fee. Okay. Which also means there's a self-interest threat because we want that fee to be really high. So we might not challenge something that brings that profit, let's say, down. And then we're like, oh, our fee's gone lower. Well, let's challenge that bit less, make that profit go higher. And funny enough, we ended up with a good fee, okay, or even better. And then the final bit, so there's a bit on potential other issues, professional issues. So it wasn't necessarily the timing this time. It was actually this, we had less staff. Maybe someone went off sick on holiday or something. That's going to challenge the quality of the work. Okay, it might mean that actually we miss stuff, or maybe staff have to skip corners. They're more likely to do that. Okay. And also the FD had only been enrolled for 6 months. Now, the FD might be really experienced elsewhere, but maybe not in this industry, maybe doesn't understand the business as much yet. So might be making some errors, okay? Might be making some poor judgments. So that's what we're concerned about, okay? Now, a lot of this you can see is about justifying, being clear, explaining, okay? So hopefully this was helpful. As always, just give me any comments you've got in the chat, okay? And then also, if you haven't watched the question one debrief, go back and have a look at that as well. And see you next time.